Welcome to this edition of Taking Stock for the week ending the 13th of December 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me again today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. Again, I can't believe the year's just flown by so quickly. This is our second last Taking Stock for the year, and good to have you on board again.
Thank you. It's always a pleasure to be here, Kian, and it's Friday the 13th today as well. So it might be a particular day for some people out there. It could be the real Black Friday.
I know. I spent all my money on Black Friday, talking about Black Friday. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance in this episode. But as the year winds down, Jace, investors are becoming more cautious, especially with market valuations at elevated levels. And the focus this week has been on interest rates and inflation again. In the US, we saw the latest consumer price index showing a 0.3% increase in November, and that was largely matching market expectations. We had the annual inflation rate rising to around 2.7%. That's slightly up from 2.6% in October. But despite this uptick, the US Federal Reserve, they are expected to implement a quarter point interest rate cut next week, the third for 2024, Jace.
Yeah, interesting stuff for what's happening over in the US, Kim. But here in Australia, the RBA has kept interest rates on hold at 4.35%, citing September inflation figures with an annual core inflation of around 3.5%, still above the RBA's target band. Now, however, the unemployment rate unexpectedly dropped to 3.8% in November, and this was down from 4.1% in October. So the robust labor market performance may challenge the likelihood of an early rate cut that was previously anticipated for February 2025.
Yeah, we'll speak more about interest rates later in this episode, but also weighing on the market this week has been some price pressure on those banks, and investors are taking profits and reallocating those funds towards resources. And sentiment across the banks, they have fallen after ANZ did announce the retirement of its CEO on the back of this bond trading scandal. But we'll touch on this a bit later. So among our star stock highlights this week was Spark New Zealand, which announced the sale of its remaining interest in Connexa, its mobile towers business, for around 314 million. Jace, can you tell us a bit more about this sale?
So Spark is selling its stake to a global investment group, and this sale aligns with the previous market valuation and is expected to boost Spark's profits by around $70 million when the deal concludes in the third quarter of FY25. Now, Connexa's majority shareholder, which is the Ontario Teachers Pension Fund, is also selling 33% of its shares. Post the transaction, CDP, which is the Global Investment Group, and also the Ontario Teachers Fund will each own 50% of Connexa.
Yeah, very interesting there, Jace. And while Spark will relinquish its board roles, it will remain a key customer and retain control over network development as well. And this move is part of Spark's strategy to focus on their core assets, strengthen their balance sheet and financial health, and enhance their earning stability, which should support their free cash flow and provide some stability for their dividend distributions as well. So its dividend yield is currently at around 8.5%. Now, moving on to Star Income stock as well, another one, APA Group. There have been a few announcements here. APA, the utility gas provider network. Firstly, UniSuper has sold their remaining stake in the company. Do you think this is a sign for concern?
Yeah, it's a good question, Ken. It's always one of those things that investors ask themselves if a large super fund or a large holder sells out a stake. Now, with UniSuper's case, they sold their remaining stake in APA, and that was worth roughly $340 million following a $500 million sell down in late October. In the context of UniSuper's portfolio, the APA exposure represents a very small investment. There were some suggestions, however, that the super fund had an active mandate to champion decarbonization in the company, and it's been trying to discourage the business from developing gas pipelines in the Beetaloo Basin. However, the company's chief investment officer did state that the sale was more likely due to an internal rebalancing of its portfolios rather than anything else.
Yeah, Jace, it's clear that the ESG considerations are becoming increasingly significant in the mandates of many asset managers. And on another note, though, a lingering concern for APA has been the possibility of tighter regulations on its Southwest Queensland pipeline by the Australian Energy Regulator, or AER. However, APA did recently confirm that the regulatory framework will remain unchanged, which is a positive development for the stock as well.
Yeah, I think that's right, Ken, and that's why the market has responded quite well to this news, though it was largely anticipated. But I guess the positive side, it removes a lot of the overhang on the stock, and that's why the share price has re-rated up a little bit. Currently, APA is on an attractive dividend yield of around 8%.
Yeah, thanks for that, Jason. Moving across to our other high yield stocks, we had Dexus Industrial REIT, DXI is the code here. They've entered our Star Income universe during the week, and they own a diversified portfolio valued at around 1.4 billion, consisting of around 89 properties across key Australian cities. And of course, as the name suggests, focusing on industrial warehouses and business parks. The REIT is currently on a dividend yield of around 6.5%. Jace, why have we initiated coverage on this REIT at this time?
Well, the REIT is going ex-dividend at the end of December, and given that interest rates are expected to fall next year, we decided to look for some opportunities within some property trusts where the share price may have been a little bit oversold. And Dexus Industria has confirmed that it will pay 16.4 cents per share dividend in FY25. Other REITs that we have introduced include National Storage REIT, also HomeCo Daily REIT, which are on dividend yields of around 7.3 and also 4.8%.
Yeah, so please refer to our commentary for more information. In Under the Microscope this week, we examine ANZ Group. Among the major banks, it is experiencing some heightened active risks, including a management transition, also the integration of Suncorp Bank, and of course, the trading scandal that could impact its reputation and earnings. First up, ANZ has announced the retirement of its CEO, Shane Elliott, and the appointment of HSBC executive Nuno Matos. What is the reason behind this decision, Jace?
Well, Mr. Elliott is retiring after 9 years, and this is amid regulatory scrutiny over the alleged bond trading misconduct that you mentioned before, Kien. Mr. Matos has been chosen for his international banking experience and also expertise in managing large-scale business integrations, as well as his ability to advance digital platforms, and this should align with ANZ's strategic priorities. However, the share price did fall because the market appears quite rather concerned around potentially his unfamiliarity with the Australian banking sector and also the lengthening transition period before he resumes the role in July 2025. So his selection over internal candidates could impact a little bit of morale amongst the ANZ senior management team, and this could lead to further departures.
Yeah, interesting points there, Jason. ANZ is undergoing an ASIC investigation into their bond trading scandal, and the bank is alleged to have manipulated bond rates, which forced up the government's borrowing costs during that 14 billion debt sale. A few investors may be wondering about the earnings impact of these allegations.
Well, bank scandals are never really far in between. I mean, we've witnessed a lot of bank scandals over the number of years, and I mean, we shouldn't be dismissive of the latest one from ANZ. The financial penalty could be as large as $780 million, which is a decent chunk of change. So while the figure represents only 1% of ANZ's total profits, the broader impact could also include increased compliance costs, operational restructuring, also potential operational damage as well. And this could also limit future revenue opportunities, especially from government bond yields.
Yeah, no doubt. Adding to these challenges, though, ANZ is concurrently managing its merger with Suncorp Bank, which is a massive integration effort. These combined risks are reflected in the stock's high dividend yield of around 7.4%, and that is a sign that the market is pricing in this significant uncertainty as well.
Yeah, and looking at the yield, I mean, it looks rather interesting, but it's not smart just to invest in the company based on this alone. You'll also need to understand the risks and be comfortable with them as well. Each bank has a rather unique set of attributes, and you can compare these factors in Stock Doctor using the peer comparison table under the 9 golden rule screen, or via the Star Income Stock Watch List, or even creating your own filters.
Yeah, so if you're comparing those banks, for instance, Bank of Queensland has a very similar dividend yield with a premium driven by its regional status and also restructuring issues, as well as all owner branches are transitioning to that corporate branch next year. But investors seeking stability, though, would want to take a look at Westpac and National Australia Bank. They continue to offer attractive dividend yields at around 6.5%, with fewer operational risks than ANZ. Meanwhile, you have CBA. They are the most profitable bank due to their strong market position and lower operating costs, but investors will need to accept a lower yield for it, currently at around 4.3%. So, with the RBA expected to cut interest rates in early 2025, a question that is often asked among our members when that happens is, how will lower interest rates impact our star stocks?
Well, Keen, from an earnings perspective, lower interest rates could benefit sectors often called the bond proxies. And these include stocks with high debt and also substantial tangible assets, such as REITs, infrastructure, utilities, and also telecommunications companies. So, for example, star stocks like Telstra, Spark New Zealand, APA Group, and also REITs like BWP Trust, Homeco, National Storage, and Waypoint would see their asset values rise and their borrowing costs potentially decrease on the back of this.
Yeah, and don't forget, Jace, that growth stocks, especially those in technology, also benefit since their future cash flows are discounted at those lower interest rates, enhancing their present valuations as well. Star stocks also, like retailers like Breville, Wesfarmers, and Accent Group, may also see a lift as consumers have more disposable income due to their lower debt servicing costs. In addition, you've got housing related stocks like James Hardie and REA Group. They could be beneficiaries of rate cuts as well.
That's right, Ken. And also other beneficiaries could also include gold stocks as well, as this sector could gain a bit of momentum as lower interest rate reduces the opportunity cost of holding non-yielding assets. Plus, stickier inflation could also support the potential investment in gold as well.
Yeah, on the other hand, though, financials such as the banks and insurers, they do face challenges when interest rates are lower, because lower rates compress their net interest margins, and that is the gap between the lending and the deposit rates, pressuring bank margins. And insurers, on the other hand, predominantly invest in bonds, and they could see lower returns on their portfolios.
That's right, Ken. So at a stock level, Challenger, for instance, this company might face additional headwinds due to its investments in fixed income securities. In addition, annuity demand could weaken as the rates on their annuity products could fall in line with interest rates as well. Meanwhile, other financials like Computershare, which earn interest on its client accounts, could also be negatively impacted.
Yeah, thanks, Jace. The key takeaway, though, is that while lower interest rates influence earnings, they're just one of many factors affecting the operational performance of the business. If you think about it, high quality, financially sound companies with stable cash flows and a strong market position, they remain the cornerstone of a resilient portfolio. Factors like return on equity, profit margins, and earnings revisions are the critical metrics to focus on. That's all we have time for today. Next week, Tim will join us for the final episode of Taking Stock for 2024 as we discuss key themes for the year ahead. But thanks for your time today, Jace. It's really appreciated. Last week you were here and this week you're here again. And yeah, your insights are always valuable.
Thanks, Ken. It's always a pleasure to be presenting to the membership base, and also looking forward to wrapping up the year on a high note as well. So take care, everyone. Thank you so much for your time over the past year, and it's been a pleasure from the whole team.
It certainly has. And to everyone out there, until then, we wish you a happy, healthy, and prosperous week ahead.